Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at whether or not investors should consider buying Netflix stock before its upcoming earnings report. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so we're going to jump right into it today. Netflix stock has clearly benefited from the coronavirus stay-at-home environment alongside the likes of Zoom and Amazon and all of these other big tech names that have had a successful pandemic run so far. The streaming giant doubled its own subscriber growth estimates in Q1, which only included several weeks of the lockdown period. The stock is now up about 57% in 2020. So now we're going to jump into all the details to see if you should consider buying the stock before they release their quarterly earnings results after the closing bell on July 16th. So this upcoming Thursday. So as we mentioned, Netflix added 15.8 million global paid users in the first quarter to crush its own 7 million user guidance that it provided when it reported its Q4 results. That clearly came out well before the coronavirus turned into a global pandemic. So they did not anticipate that 7 million guidance, was not thinking, oh man, everyone's going to be locked down in their home and downloading our streaming TV service, because that's really all there is to do. So they've clearly benefited from the fact that people in the US and around the world were asked to stay at home starting around early to mid-March. And we'll see how those results pan out as people slowly return to something close to more normal lives. With this in mind, Netflix is the world's largest streaming TV firm. It closed that first quarter, which ended on March 31st, with 183 million global subscribers. And let's not forget that Netflix is also expanding its user base and global reach within the last decade as part of a secular trend that's really unlikely to reverse. So it's not like they've only benefited because people are staying at home. This has helped them maybe more in that first quarter, but it's not like people weren't already transitioning in general to streaming. So this might have just helped push it forward maybe faster than they could have anticipated, especially in that first quarter. So with this in mind, they do face competition from newcomers. This includes Disney Plus, Apple TV, the beefed up HBO Max, that new Peacock service that's debuting, and you have Amazon and others as well. However, millions of more people are still projected to cut the cord over the next several years. So unlike some of the narrative that surrounds, and the actual facts that surrounds Apple Music versus, say, Spotify, the streaming TV firms offer, for, in general, vastly different content libraries. There is some overlap sometimes, but for instance, Disney announced that as of May 4th, it had about 55 million Disney Plus subscribers, which was up from 33.5 million as of the end of March. So they're already up to 55 million after debuting this past November. So some big numbers for Disney Plus. And this is coming as Netflix also blew out their own Q1 growth. So I say that to show that people are downloading more than just one service. There's not well, if I have Netflix, then I don't have to have Disney Plus, because they're offering vastly different things. And now going forward, they will continue to offer pretty much nothing that's on one service that's on the other service. Disney also noted that it owns Hulu at this point. That had 32 million total subscribers, up from 30 million in the quarter before that. And ESPN Plus, which is its streaming pared down version of ESPN, had about 8 million subscribers, up from just 2.2 million in the year ago period. So continued growth for Disney's newer streaming services, Hulu as well. And that's including that Netflix is also growing. So it's not this scenario where people thought that if Disney Plus wins some subscribers, Netflix will lose them. It's not a zero-sum game. These streaming services will be able to continue to grow kind of all together. Obviously, things could change going forward based on what is actually on these services, but the basic premise is that people who sign up for Disney Plus or other services don't necessarily have to dump Netflix or vice versa. So if we take that near-term coronavirus view, Netflix stands to benefit greatly as movie theaters, concerts, sports with fans in attendance won't be back in general and at least en masse anytime soon, even as the economy slowly returns to something close to normal as it reopens. Obviously, we have some spikes that are slowing some of those reopening plans throughout different areas of the U.S. But even if things go as well as they can in the next, say, 6 months, it's doubtful, at least in my opinion, that movie theaters and concerts and sports with fans will be the back anytime soon. Maybe pared down version of it. But the basic premise is that Netflix is going to be continuing to operate in an environment where that streaming is some of the only entertainment people have to turn besides being outside and obviously other various things. So meanwhile, on the stock front, Netflix stock has outpaced Amazon over the last 3 years. And it was also one of the top performing stocks over the last decade. And if we look more recently, its shares began to break out from the roughly year plus slump starting in the fourth quarter of 2019. So the stock is now up roughly 90% since October of 2019. And it's up relatively significantly so far this year, as we mentioned earlier as well, up about 57% since the start of 2020. This tops all of its other FANG peers besides Amazon, which is up about 65% over this stretch, but it nearly doubles Microsoft and Apple and well above Facebook and Google as well. So with this in mind, the firm did see its stock price fall on Tuesday, with it down over 3% at one point. It was about 2% lower as of mid-morning trading on Tuesday. Overall, the stock is now down about 10% from its recent intraday highs of $575 a share. It was trading at about $515 per share as of Tuesday morning. So a slight, maybe a possible buy the dip where people were really running up Netflix stock heading into the report. You see a bit of a pullback that could set up people who are very bullish on Netflix to have a better buying opportunity. So that big decline today, some people are putting that in the back of UBS analysts downgrading the firm to neutral from a buy, citing valuation concerns and the fact that investors have perhaps already priced in some of the stay-at-home positives. With that said, the analyst did also maintain his $535 price target, which is elevated about $20 above the stock's current price at the moment of about $515 per share. And so far, if we look just at a broader picture, as I mentioned, Netflix stock is up about 57% in 2020. This makes it the fifth top gainer on the S&P 500 so far in 2020. And obviously, any stock or a company that's able to grow during this coronavirus period might be able to continue to climb. Maybe not at these levels of this 57% growth, but it does seem not too hard to believe that if stocks continue to fare well during this environment, that the companies that will be the top performers will continue to be the likes of Netflix and Amazon and these companies that can perform well at the stay-at-home environment. So as the UBS analyst mentioned, some people have some valuation concerns for Netflix, but if we look at it trading at 12 months sales estimates, it's trading at about 8.5 times forward 12 month sales at the moment, which is below its 2-year highs of about 9.5. And it's really not too far off its median over this stretch of about 7 times forward earnings. And if we look, the only other real pure play streaming TV stock is Roku, and that trades at about 10.1 times forward 12-month sales. So Netflix is trading at a solid discount compared to Roku. Once again, it's trading about 8.5 times forward 12-month sales, which is below its 2-year highs and not too far off its median over the stretch. So in terms of that forward sales, its valuation picture is hardly that stretch, but some people might be pointing more towards its forward earnings or its trailing earnings in terms of that valuation picture. Obviously, there are also some concerns about Netflix growing debt load as it's taken on debt to continue to fund its massive content push, which it plans to continue to do for at least the near term future. But obviously, during this recent period and over the last several years, we've seen that Wall Street doesn't seem that worried, and they've seemingly approved of their ability to take on a debt to fund this content, which is really needed at the moment, especially when you have all of these new rivals popping into this streaming space. So now we're going to go ahead and take a look ahead. So Netflix executives last quarter called for the company to add about 7.5 million users in Q2 to see it hit about just over 190 million total. This would mark about 26% growth from the year ago period. That would also be its highest percentage growth over the trailing 4 quarters. So that's a solid thing to notice that growth is there. And then if we look so far, FactSet's official forecast is matching the companies at about 7.5 million. But over the last several weeks, we've had analysts at Goldman Sachs and Credit Suisse and other places push their paid subscriber projections all the way up to 10 to even 12.5 million new paid subscribers, which would be well above what Netflix executives called for last quarter when they knew about the current coronavirus situation. And with that said, the company itself has cautioned that its record-busting quarter of about 16 million subscribers in Q1 could have seen people who might have waited later in the year to add Netflix just to add it right away. So they're sort of tempering expectations for Q2. With this in mind, anyone interested in investing in Netflix should always note that the shares do tend to trade pretty heavily based on if it is able to beat or miss its subscriber growth. Obviously, people still care about earnings and revenue growth, but those subscriber figures are what Wall Street investors have focused on for a very long time. And on that note, the summer has tended to be not the best period for Netflix. Its shares have fallen sharply following in 3 of the last 4 second quarter reports. So following Q2 has not been the best time for Netflix. With that said, Q2 has also seen the company have some pretty big misses. So Q2 of last year, there was a massive miss, sent the stock price down big. And then Q2 of 2018, also a pretty solid miss, but the big beat in Q1, you never really know. But with that said, that Q2 has not been the best period. Post Q2 has not been the best period for Netflix stocks. And in 2018 and 2019, it did have a big miss during that period. But obviously, the coronavirus was not a thing at that point. So it's hard to imagine that Netflix would underperform, but it's still needs to be seen if they're going to greatly outperform like some of these analysts are projecting. So if we look ahead to our current Zacks estimates, we're calling for its revenue to jump about 23.5% to just over $6 billion. And if we look further ahead to overall 2020, its sales are projected to climb about 23%. And it's worth noting both of these would mark slowdowns compared to Q1 of 2020 and overall fiscal 2019's 28% top line growth, as well as other recent periods. And then if we look ahead to 2020, we're calling for just 18% top line growth. So for 2020, we're calling for 23%, and in 2021, we're calling for 18% growth. And just to put that in perspective, the worst growth they've had, or the slowest growth they've had in the last 6 years, was in 2015 when they climbed at just over 23% growth. In the last 4 years, they've seen 30% growth, 32% growth, 35% growth, and then 28% growth. So a bit of a slowdown compared to what they've done over the last 4 years, at least, is what we're projecting. But still some solid top line growth for a company of its size and age. And that top line growth compares pretty well to some of its FANG peers, and looks really well when you consider how much some other companies in various industries are going to be negatively impacted by the coronavirus economic downturn. And then Its bottom line looks even better. So on the bottom end of the income statement, Netflix adjusted Q2 earnings are expected to skyrocket nearly 210% to $184 per share. And its adjusted 2020 earnings per share figure is projected to jump about 56%. So big bottom line growth we're calling for. And its earnings revisions have turned more positive broadly since it reported its Q1 results, and its Q2 estimates up just in the last 7 days. That helps it earn a Zacks rank number 2 buy at the moment, heading into its second quarter release on Thursday. So overall, the streaming TV stock really does clearly appear to be worth considering as both a coronavirus play and a longer term bet on the future of entertainment. Obviously, betting on the stock for a post earnings jump is largely a bet on them having blowout subscriber growth where they top their own estimates. So that's, no one really knows at this point. As I said, it's harder to believe that they won't at least match that, but some of these big, huge doubling like they did in the Q1, it does seem like it will be a little harder to get that. Overall, though, its stock is up big, so obviously no one really knows what's going to be happening in the second half. But if we look at overall S&P 500 earnings for the entire index, Q2 earnings are expected to be down about 45% based on our most recent Zacks data on about 11% lower revenue. So compared to the broader S&P 500, Netflix looks to be in a great spot. So this could continue to help the stock grow in 2020 and down the road. But Q2 earnings season could create some more volatility. So it will be interesting to watch. And then obviously one thing to pay attention for both that short-term growth is what their management team and their executives have to say about their production schedule, which obviously all of Hollywood is pretty much still shut down at the moment. So how will it affect their near-term and upcoming content slate? Luckily, Netflix isn't the only one in this situation where they're not able to produce shows at the moment. So if Netflix stock goes down, this is also affecting Disney and other companies and Roku of the like. So all of these companies will be affected, which does help Netflix, because it's not like people are going to dump Netflix because there's no new content, because there won't be any new content coming anywhere for these streaming services. And as I mentioned, movie theaters aren't going to be the first place people jump back to. There won't be live sports with fans in attendance, concerts. All of those things will be some of the last things to return when we come out of the other side of this coronavirus economic downturn. So once again, the stock is a number 2 buy heading into earnings. It trades pretty heavily based on if it beats or misses its own user growth guidance, and it reports after the bell on Thursday. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.